Tax Cuts and Jobs Act of 2017 introduced several significant changes aimed at reforming both individual and corporate taxation in the US with a focus of encouraging companies to invest and report profits domestically. Now, before the Tax Cuts and Jobs Act, US companies were taxed on profits repatriated from foreign subsidiaries, which led many companies to keep profits abroad to avoid US taxes. The Tax Cuts and Jobs Act moved the US tax system towards a territorial model, eliminating taxes on repatriated active profits, allowing companies to bring back cash to US without incurring additional tax burdens. However, some companies still choose to keep funds abroad, benefiting more favorable tax treatments in foreign jurisdictions. In this section, let's understand different provisions of Tax Cuts and Jobs Act. Let's understand major provisions of Tax Cuts and Jobs Act. Corporate tax rate were as high as 35% in the US, and Tax Cuts and Jobs Act reduced the corporate tax to 21%, providing direct relief to US companies and encouraging them to repatriate profits and invest domestically. Pass-through entities such as partnerships and sole proprietorships, they receive a 20% deduction on qualified business income, making it easier for smaller businesses to benefit from lower tax rates. Territorial system was eliminated. Eliminating taxes on the repatriation of foreign profits made it easier for US companies to bring profits back home, but one-time transition tax was imposed on previously accumulated and repatriated foreign profits. The major objectives of Tax Cuts and Jobs Act to work on tax base erosion of US. So they brought many provisions. One of them was preventing companies from shifting their companies to tax haven countries. The reason why they were moving to tax haven countries was the corporate tax rates were really high in the US. So Tax Cuts and Jobs Act brought it down to 21% from as high as 35 to 37%. Also, companies moving abroad were not bringing or not distributing their profits because they knew if they distribute these profits that were taxable as dividend income. So therefore they did not bring it back. So now Tax Cuts and Jobs Act brought in a provision where foreign distributions, direct foreign distributions are no longer be taxable now. Also, what about the previous profits accumulated? They were supposed to bring it back. So therefore section 965 was brought in, which is a transition tax which was assessed and to be paid in certain installments. And then we had GILTI. This was a provision for companies to shifting intangible assets abroad and creating sales and profits through these intangible assets, because intangible assets are easy to be shifting. We can easily shift intangible assets. So provision of GILTI was brought in to prevent companies from registering intangible assets outside the US and booking profits there. Also, a provision for FDII was brought in. This was to encourage companies to create and register intangibles within the US and export these intangibles outside US and earn profits. So there was a reduced tax rates for FDII provision was brought in. So these were the major provisions that was brought by Tax Cuts and Jobs Act. Let's visualize the whole issue. We have Concord Corporation, which is located at the US. Okay, so now they have a marginal tax rate, corporate tax rate of 35%. So these shareholders, the shareholders of Concord Corporation, they thought about having this company shifted to Bahamas, where they have 0% corporate tax rates, and they operate the company in Bahamas now. Now, obviously, they receive dividends from these corporations, and they know that if they bring it back to the US, this would be taxable. So therefore, they would never bring it back. And this was the situation now. And that's where Tax Cuts and Jobs Act try to basically prevent these kind of issues. So there are different provisions which is brought in by the Tax Cuts and Jobs Act, and let's dive in to understand. To understand the provisions of Tax Cuts and Jobs Act, we need to understand what exactly is a controlled foreign corporation, what exactly is a CFC. A CFC is a company which is owned by US shareholders. Now, CFC's rules were implemented to prevent US taxpayers from deferring US tax on income earned through foreign subsidiaries. Without these rules, US taxpayers could potentially avoid paying taxes on foreign profits until they are repatriated. A controlled foreign corporation is any foreign corporation where US shareholders own more than 50% of the stock, which could be either by vote or by value collectively. These shareholders can be individuals, corporations, partnerships, trusts that are US persons. So a US shareholder in this scenario could be calculated as somebody who has at least 10% or more of foreign corporation stock, either directly or indirectly. So we need to understand this. So what is a CFC? Now, let's say we have Concord City Corporation. These are owned by US shareholders. Now, let's say this is a corporation which is set up in a tax haven country. So we have certain shareholders. Shareholder A owns 23% of the company. Shareholder B owns 20%. Shareholder C 25%. And then we have shareholder D who owns 25%, another individual. We also have another individual who owns 7%, shareholder X. Now we don't consider this shareholder X as a shareholder here because his stake or his shareholding is less than 10%. So when we talk about CFC, we do not consider anybody who has a stake below 10%. So therefore, this person would not be counted. The shareholder X would not be counted as a shareholder. The others, shareholder A, B, C and D, they have a combined shareholding of more than 50% of the stock of CFC. So therefore, this Concord City Corporation would be considered as a CFC. US shareholders of a CFC must file a Form 5471 with the IRS providing detailed information about CFC's income, assets and ownership structure. Failure to file this form can result in significant penalties. We also need to understand what exactly is a specified foreign corporation, an SFC. A specified foreign corporation is a category of foreign corporations defined by the US tax law, particularly in relation to the transition tax provisions of Tax Cuts and Jobs Act. The term SFC played a key role in the imposition of one-time transition tax on previously untaxed foreign earnings held by certain foreign corporations. An SFC refers to controlled foreign corporations where a foreign corporation in which US shareholders own more than 10%, on combined they own more than 50% of voting power or stock value. It also includes other foreign corporations wherein at least one shareholder owns more than 10%, who is the US shareholder. So therefore, all CFCs are considered SFCs, but all SFCs may not be a CFC. The US shareholders of an SFC could claim foreign tax credit for taxes paid by SFC to foreign governments, which could offset some of their transition tax liability. Now, who were the people who were affected by the SFC rules? Certain US corporations where SFC rules and transition tax affected US multinational corporations with significant foreign earnings. It also affected certain individuals who are US shareholders. US individuals who held at least 10% of the stock in a foreign corporation classified as an SFC were also subject to transition tax. One of the provisions of Tax Cuts and Jobs Act was the introduction of Subpart F income. Now, Subpart F income refers to certain types of foreign income earned by a CFC corporation that are subject to immediate US taxation for the CFC's US shareholders, even if the income is not repatriated back to the United States. These rules were designed to prevent US taxpayers from deferring US tax by keeping income in foreign subsidiaries located in certain law tax jurisdictions. We need to understand different types of Subpart F income. We have foreign-based company sales income. This is income earned from purchasing goods from a related party and selling them to another related party, where the goods are both produced and sold for use outside the CFC's country of incorporation. We also have personal holding company income, certain income such as passive in nature. These are dividends, interest, rents and royalties, capital gains, and similar investment income. We also have insurance income, where income earned by a CFC from the insurance of risk outside its country of incorporation. We also have certain foreign-based company oil-related income derived from the processing and transportation of oil and gas outside the country where CFC is incorporated. Not all income earned by a CFC may not be included in Subpart F income. So we have certain high tax income. Now let's say a CFC is subject to a foreign tax at an effective rate that's higher than 90% of the US corporate tax rate. So currently the tax rate is 21%. So if the foreign country has a tax rate which is 90% of US tax rates, then those companies' income would not be considered under Subpart F income. We also have certain de minimis rules wherein a CFC's total Subpart F income is less than a certain threshold. Let's say 5% of gross income or 1 million, whichever is lower, is excluded from taxation. We also have some income which is generated from within the country. So income earned from transactions conducted within the same country as a CFC is generally excluded from Subpart F income. We need to visualize Subpart F income. Now let's say we have certain US shareholders. They set up a CFC in Bahamas wherein we have 0% corporate tax rates, and then they sell it to let's say to Africa, and they sell it to Europe. Okay, so in this case this would be considered Subpart F income. If they need to sell it to Europe or Africa, they shouldn't be setting up their business in Bahamas. There is no business reasons, there is no strategic reasons why this new city corporation CFC is located in Bahamas. This is the sole reason for production of their taxes. So if they earn certain income such as sales, service income or portfolio income, all will be subject to Subpart F income, and they need to pay 21% corporate tax rates for these sales, even if it is earned in Bahamas. Let's now understand what is a non-Subpart F income. Now let's say these US shareholders, they create a company. Okay, this is in UAE. Okay, they create a company in UAE, and then they source the raw materials from China, and then they process this in UAE, let's say Ras Al Khaimah or somewhere, and then they process this raw materials imported from China, and then they sell it to Middle East. There is a business reason for this, isn't it? They have set up the CFC, or they have set up this company in the UAE for a business reason. So therefore, this will not come as in the case of a Subpart F income. This would be excluded from calculation of Subpart F income. Another provision of Tax Cuts and Jobs Act was the GILTI, Global Intangible Low Taxed Income. GILTI was implemented to address the issue of profit shifting, where US companies were moving profits on intangible assets such as patents, copyright, subscription revenues, and so on to foreign subsidiaries in low tax or no tax jurisdictions to reduce their overall US tax burden. GILTI is meant to discourage these companies from concentrating their earnings in countries where low taxes by shifting their intangibles and reporting income on those intangibles outside the US. Let's now understand GILTI provisions. Now let's say we have certain US shareholders. They have transferred certain of their intangible assets. These are copyrights, patents, subscription revenues. Now we need to know that shifting intangible assets are really very easy. Now if you think about corporations like Boeing, where they create or they manufacture aeroplanes, these companies cannot shift their projects, they cannot shift their machineries, plant and equipment to a different tax haven country so easily. Now intangibles are very easily shiftable assets. So let's say in this case, these US shareholders, they shift their intangibles to a company that they create in Bahamas, where corporate tax rate is really very low or near to zero, and they register these intangibles there, and then they start selling it from there. So now GILTI provision applies here. Now if their tested income is over and above 10% of their average assets, oftentimes we call it QBAI. If their tested income is over and above 10% of QBAI, they are subject to GILTI taxes. They will have to pay 10.5% of GILTI taxes over and above 10% of their QBAI. US shareholders of a controlled foreign corporation are subject to GILTI. Now GILTI applies to US corporations and individuals who own interests in CFCs, although US corporations may receive certain tax benefits under GILTI that individuals, taxpayers do not have. How do we calculate GILTI? GILTI is calculated as the excess of CFC's total income over a 10% return on the company's qualified business asset investment, often called QBAI, which is essentially the company's tangible assets such as equipments and building. So the formula is CFC's net tested income minus 10% over and above CFC's QBAI. How do we calculate the tested income? Now this is the CFC's gross income excluding certain types of income like Subpart F income, income that is effectively connected with a US trade or business, and income subject to high foreign taxes. We must also understand the QBAI, qualified business asset investment, which represent the CFC's average adjusted basis in depreciable tangible property used in trade or business. So the assumption is that if you earn more than a reasonable return, more than 10%, the profits beyond this 10% is considered intangible income, and therefore they are subject to GILTI tax. However, you must understand that GILTI applies to both intangible and other types of tangible income exceeding this particular 10% threshold. Now for the corporate taxpayers, they are allowed to take a 50% deduction on GILTI tax under section 250, effectively making the corporate tax rates on GILTI 10.5%, which is 50% of the 21% US corporate tax rate. Now for 2025 onwards, the deduction would be dropping to a 37.5%, increasing the GILTI to 13.125%. Now when it comes to individual taxpayers, they do not receive the 50% deduction and they are taxed at their ordinary income tax rates. However, individuals can make an election to be taxed as a corporation under Section 962, which allows them to take the advantage of the lower corporate tax rates on GILTI. As we understand, US shareholders were accumulating earnings and profits in foreign corporations, and then they were never bringing it back to the US, as they understand that these distributions would be taxable in the US. So therefore, the sole purpose of Section 965 was to impose a one-time transition tax on any previously untaxed foreign earnings held by these corporations. Now, this tax was as part of a broader shift from worldwide tax system to territorial tax system, which generally exempts future foreign earnings from US taxation. Now let's understand and visualize Section 965. Let's say we have Concord Corporation, which is previously located in the US. Now, to take advantage of the lower tax rates in Bahamas, they have set up a CFC in Bahamas, and they understand once they receive the dividends and once they transfer it to the US, then this will be taxable. So therefore, they do not distribute these dividends to the US tax shareholders, and therefore they accumulate these earnings without distributing these earnings, because they understand once they distribute, this would be taxable. So that's the sole purpose of Section 965, to tax on these accumulated earnings since 1986 till the Tax Cuts Jobs Act of 2017. So what exactly Section 965 do? The Section 965 was imposed as a mandatory one-time tax on the accumulated post-1986 untaxed foreign earnings of SFCs, the specified foreign corporations. Now, this tax was applied regardless of whether the earnings were repatriated back to the US or not. Now, SFC include all the CFCs, controlled foreign corporations, and other foreign corporations that have at least one US shareholder owning more than 10% of the stock. Now, the transition tax was designed to bring an end to the deferral US taxes on foreign profits that had been accumulated and not yet taxed. Under Section 965, US shareholders of SFCs were required to pay one-time tax on the accumulated but previously untaxed earnings and profits of the SFCs, whether or not these earnings were repatriated. The transition tax applied at a reduced tax rate of 15.5% for cash and other liquid assets and 8% for non-cash assets. Now, the transition tax was designed to capture US tax on earnings held by foreign subsidiaries that had not been repatriated under the old worldwide tax system. So when it comes to tax rate for cash and cash equivalents, earnings in cash or equivalents or other liquid assets were taxed at 15.5%, and all the other assets such as property, plant and equipment were taxed at a lower rate of 8%. Now, Section 965 tax liability was assessed or incurred immediately. The taxpayer were given time over an 8-year period to pay this, because this is going to be a huge liability for them, and they were given time to pay this. So these were calculated as installments, and installment from first year to fifth year is going to be 8% of the net Section 965 tax liability. So that's going to be 40% over 5 years. And then in the year 6, you have 15% to be paid on the tax liability, and then installment 7 is going to be 20%, and installment 8 is going to be 25% of the net Section 965 transition tax. So these taxes would be assessed immediately as per the Jobs Act, and then the taxpayers are given time to pay this. They can defer these payments over an 8-year period. Okay, first year through fifth year, it's going to be almost 40% of the tax liability, and sixth 15%, and seventh year it's going to be 20%, and eighth year 25% of the net tax liability. So as we understand, the tax rates are going to be 15.5% for aggregate foreign cash position and 8% for the remainder. Since the Tax Cuts and Jobs Act has made the corporate tax rates to 21%, anything less than 21% would be considered as a special deduction. So in this case, the special deduction for cash position is going to be 26.91%, which is 21% minus 15.5%, and then 61.90% of special deductions for non-cash positions. So that's going to be 21% minus the 8%. The aggregate savings on special tax deductions would be 61.90%. Another provision of Tax Cuts and Jobs Act was the BEAT tax, the Base Erosion and Anti-Abuse Tax. This was introduced to prevent large US corporations from eroding US-based tax by making excessive deductible payments such as interest, royalties, or consultancy fees, management fees, and service fees to related foreign affiliates in low tax jurisdictions. Now, BEAT applies to all these foreign corporations who would make payments, discretionary payments, to their foreign affiliates. BEAT would apply an additional tax to certain corporations that engage in base eroding payments to foreign affiliates, ensuring that they pay a minimal level of US taxes regardless of these deductions. The provision of BEAT was designed to curb profit shifting for large corporations. Now, it targets companies that reduce their US tax liability by shifting profits overseas through payments to their foreign affiliates, such as royalty payments for intellectual property and interest payments on intercompany loans. By imposing an alternative minimum tax, BEAT reduces the incentive for companies to move profits outside the US and aims to protect the US tax base. So not every corporation is affected by BEAT. Now, BEAT is applicable for larger corporations. Corporations are considered as corporations with gross receipts of 500 million or more over the last 3 preceding periods. Now, additionally, to be subject to a BEAT tax, the company must have base erosion payments that constitute at least 3% of the total deductions. When it comes to banks and other certain financial companies, it will be 2% of the total deductions. Now, BEAT does not apply to smaller corporations and also companies with minimal base erosion payments. So the base erosion payments are considered at least 3% of the total deductions in certain discretionary payments to their foreign affiliates. BEAT rates are going to be 5% in the transition year, and then 10% through 2019 to 2025, and then it's going to be 12.5% starting from 2026. Now, banks and certain financial companies are subject to a higher tax rates of 11% from 2019 to 2025 and 13.5% starting from 2026. It is important that we would visualize the base erosion and anti-abuse tax, the BEAT tax. Let's say we have Concord Corporation, which is a US firm, and they have an affiliate corporation, which is New City Corporation, which is located in Bahamas. And they arranged to do certain consultancy services worth $1 million from New City Corporation. Now you see that Concord Corporation is going to take this $1 million as their expense and deduct their taxes, claiming an expense. This is where base erosion and anti-abuse tax would come into play. They would have to recalculate seeing this as a discretionary payment. Now this 1 million, if it is more than 3% of their total deductible expenses, they might come under the provision of B tax. Now, rather than punishments and penalties, taxes, we also have certain incentives, and one of them is FDII, foreign derived intangible income. Now this talks about if a company creates certain intangible assets and registers these intangible assets within the US, and then they sell it to or export these services or sales outside the US, any income derived from these sales would be taxed at lower corporate tax rates. So that's the provision of FDII. So FDII provides a reduced effective tax rate on profits from foreign sales and services related to tangible assets held in the US. So this would encompass revenue from selling, licensing or leasing property to non-US persons for use outside the US, also income from services provided to foreign persons with respect to property located outside the US. Let's say we have a US person or a US company that creates an intangible asset such as patent, copyright, or any other kind of intangible asset. They register these intangible assets and then they export to outside the US. Okay, and then they receive sales revenue or services revenue from exporting these for the use outside the US, and they generate revenues from these sales. If they generate any of the revenues on these export income, we would have a special tax rate. These income would be taxed at 13.125%, not 21%. So they get a reduced tax rate for these export income. So let's visualize the evolution of US tax system after the Tax Cuts and Jobs Act of 2017. So we have the US shareholders. If they create a CFC or SFC outside the US, any past 1986 to 2017 accumulated income would be subject to Section 965, and they will have to pay 15.5% of accumulated cash and cash equivalents and 8% on any other accumulated non-cash item. So they'll have to pay this as a transition tax over a period of 8 years. And now, if the CFC or SFC generates certain subpart F income, now this could be sales income, portfolio income, or services income, they need to pay 21% tax on these subpart F income. Now we also have a GILTI taxes. Now these are for companies which would shift intangibles outside the US and generate revenues outside the US, eroding US tax base. So there would be 10.5% corporate tax on any excess profits over 10% of their average assets. Now we also have a B tax for discretionary expenses booked by these companies, where it is going to be recalculated 10% of the modified taxable income. So this also would be recalculated, and then there'll be taxes on these discretionary expenses.